Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. Today, the markets are taking a big hit, a big hit. I'm not gonna lie to you all. It's a lot of fear out there. So we're gonna try to introduce some logic because when the fear side of our brains are kicking in, it's important that we balance that with some logic and the wise side of our brain. So we're going to look at the markets. We're going to look at where are we at in correction territory and such. The issue with tariffs. We're going to look at inflation and such. So we're going to get into quite a few things. So welcome back and everything. So I'm going to go ahead and share screen. So part of the what's happening is that obviously the tariffs that have been implemented, China came out and did some retaliatory tariffs. If you're not clear on what tariffs are, these are taxes on imported goods. And so what that did was it rocked the markets. Why did it rock the markets? Pretty much, if you're importing goods from China or other nations or using their materials and such to create your goods, then you have to pay a higher price for those goods. And so that ultimately impacts the profitability of a company, which ultimately impacts the share price. So that's just the simplest way I can explain it. But pretty much that's been a fear. Also, retaliatory tariffs, such as China came out and implemented the same amount of tariffs that we did, which was at 34%, and they did it on all U.S. goods. So anything that China imports, they're going to be putting a tax on that. So what this does is investors are fearful that this is creating a trade war where countries are going to retaliate against the United States and such, and create this dynamic um, where prices are going to be high, companies aren't going to be profitable because of all these tariffs. And so that's the fear. That's the fear in the market. And yeah, I think it's justifiable. But we want to also look at some other information to see, like, how does this actually play out? Okay, so first I want to look at the we're gonna look at the charts first. Let's go there. Let's go ahead and go to the charts. Right now, I just have Apple pulled up. And so, Apple does a lot of business in China, and obviously, they took a dive. I mean, you see this big gap here. Apple dived down. They're at about $194 right now. So that was a steep decline. But we're just going to look at the broad indices. So let's go ahead and go to the. What are you doing? Okay, hang on, y'all. I don't think my account is signed in. So let me stop sharing and let me sign in real quick because I have a annual subscription. So yeah, we'll get to that. Or actually, better yet, let's do this. Um, since you want to log me out, Trade and View, we're gonna go to Yahoo Finance and just look at their chart because I do not have time to be trying to log in and such. All right. All right, so we're going to look at the SPY. So here we go. Let me go to share screen here. All right. So if we're looking at the SPY, we can see that we're currently in a correction territory, which is about 10% or more. I mean, this is on a daily chart. So if we look at the monthly, we're down 10% on the month. That's correction territory. When you get to 20%, it's bear market territory, that's when the blood really starts rolling out. But yeah, I mean the SPY is taking a dive. I mean, if you zoom out on a longer term, um, it obviously, I mean, it's up 108% on the long term over the last 5 years. So if you bought the SPY back in 2021, you're still up. But however, this is something that um, people are looking at, and so people are fearful of. So I just actually asked ChatGPT, what does this even look like? Actually, let me change my screen. Boom. Yeah, there we go. I just asked ChatGPT, what does this even look like? Like, when tariffs happen, um, what does this even do for the market? So let's see what ChatGPT had to say. All right, so ChatGPT had to say historically, U.S. stock market performance after the imposition of tariffs has been mixed, generally reflecting short-term volatility and longer-term resilience influenced by broader economic conditions. Here's a breakdown based on historical patterns and key examples. So short-term impact in the 6-month time frame, there's increased volatility. Tariff announcements and implementations typically trigger market uncertainty, leading to short-term volatility, sharp declines, and swift recoveries. Sector-specific shifts. Sectors directly affected by tariffs are like steel, aluminum, agriculture, technology. Usually see initial sell-offs. And so, as you can see in the tariffs that Donald Trump implemented, they didn't even want to touch chips, like chip manufacturing. So, uh, I mean, the biggest chip stocks are selling off. AMD selling off significantly. Nvidia selling off significantly, but apparently those weren't included in the tariffs. Gold wasn't included in the tariffs, and then I think energy was the last one. So, in the immediate, intermediate term impact, this up to 1 year, 6 months to 1 year, there's a moderate recovery after the initial volatility. Markets often adjust, incorporating new trade costs into company valuations. Stocks may stabilize or rebound as companies adapt or pass on costs to consumers. So this is where the concerns about inflation coming back is that costs being passed on to consumers. So if a company has to pay a higher tax on imported goods, then they want to pass that cost off to the consumer, so that increases the prices. So that's the concern with inflation. Sector divergence, industries less directly impacted by tariffs or those capable of easily shifting supply chains tend to recover quicker. And then the long-term impact is resilience and adjustment. Historically, U.S. markets have largely recovered, even thrive longer term, adjusting to the new normal of tariffs. A strategic realignment, companies may realign supply chains, change trading partners, or innovate to offset tariff impacts, boosting long-term profitability and competitiveness. So if we look at historical examples, obviously we had the Smoot-Hawley tariff tariffs that were implemented in 1930, where the government implemented um, tariffs on like Canada and multiple other nations, and then they implemented tariffs back. I think it may have been 100% tariffs tax, and markets crashed, and we went to the Great Depression. So that's one example. We had the example of the steel and aluminum tariffs in 2018 under Trump. We had the U.S.-China trade war and such, and so yeah. So I mean, there's context for what's happening, but typically the markets do rebound higher. So it's important just to note that. All right, so Jerome Powell came out and he actually um, spoke, and he said that the Fed is going to stay paused, and they're just going to wait and see what happens because um, they're saying one of their mandates is managing inflation, taming inflation. Whether they were effective or not at that, that's another discussion. But that's one of their mandates. So when we look at Jerome Powell and the Fed, they're saying, okay, we're trying to fight inflation through interest rate increases. They've done few cuts last year And then this year they started pausing because there's a lot of talk about tariffs, and tariffs typically increase the prices that are passed on to consumers from businesses, which will increase inflation, which ultimately impacts the Fed's what the Fed is trying to do. So Jerome Powell said in the U.S. Said the U.S. economy was likely to face a period of higher prices and weaker growth that seemed possible a few weeks ago because of a larger than anticipated tariff hikes announced by President Trump. So many people, including myself in some cases, thought that Trump was bluffing. There's times where he talked about tariffs, then he stopped talking about tariffs, and then they pushed it back a month, then they pushed it back another month, and you can understand why people thought he was bluffing, but he actually coming out like swinging with haymakers. It's larger than anticipated. His remarks carried an undercurrent of caution about how the central bank would be able to address any fallout because the central bank will want to ensure one-time price increases don't lead to persistently higher inflation. So this is the Fed's concern. So they're saying like, okay, well, we got to wait and see before we even talk about cutting rates again and everything, because if inflation comes back, they may even need to raise rates. And so you have some economists and people that have been in the markets for a long time that have said that they believe rates are going higher, like, and inflation's not going away. So that's some things to consider. In remarks prepared for Delivery Friday, Powell indicated the central bank was still comfortable with its wait and see stance, in that it was focused above all on ensuring the public expected growth to slow down after any increases to tariffs. So while Paul acknowledged the downside risk of weaker growth had increased, he said it was too soon to say how the central bank would adjust interest rates to cushion the economy from the blow of weaker global trade. While uncertainty remains elevated, it is now becoming clear that the tariff increases will be significantly larger than expected, and the economic fallout of higher prices and slower growth is also likely to be larger than expected. Fed officials are focused on what happens to the economy after the initial hit from higher taxes on imported goods have been absorbed. They pay particularly close attention to what consumers and businesses expect to happen to inflation over several years, because they believe those expectations can be self-fulfilling. And so, yeah, so I mean, the Fed is like they're in the wait and see state, and they're like, hey, we're not gonna drop interest rates even more. Like, we need to see how this even looks first. So it's impacting the markets in that way too. Now, um, I think it's important to note that even for me, like how I'm approaching this time is I'm buying. I continue to buy because I mean, obviously, those of us that are natural resource investors, we know that it's inevitable that these prices need to go higher, that we're going to need these goods, that the world population continues to grow, and the oil market got killed. Um, we saw oil just fall significantly. We saw uranium fall significantly. Like, there's a lot of stocks that are just cratering, and so I'm actually going to share screen again with some of these companies. So let's look. So I mean, this is the S&P. If we look at oil, let's go ahead and look at something like Devon Energy. Devon Energy is at $29. Okay, let's go to the chart. Look at this big fall off, y'all. This big fall off. Okay, let me see where the chart's at. This is on the year to date. Let's go over the 1 year. Okay, so Devon Energy did have a big fall back in December, and then now it's back almost even below those levels. So companies like that. Let's look at Denison Mines. Denison Mines at $1.18. And this is the importance of, like, when we're looking at investing. Okay, this is on the 1 year. Look at the 5 year. I mean, Denison Mines is still up on the 5 year. I mean, it was, a lot lower back then in 2021, 2020, and then now it's at $1.18. So, I mean, still up if you invested early, but I mean, this is an opportunity. I mean, it's still way down off of where it was, earlier last year. I mean, it was at $2.42. So, I mean, that's over 100% increase. So, you know, all these stocks are getting hit. Everything's getting hit. I mean, even looking at this is another company I invest in, Ivanhoe Electric. Ivanhoe Electric, uh, it's Robert Friedland's company, pretty much Robert Friedland. But yeah, I mean, look at them. They focus on copper mining. And I learned about this company through the Rural Symposium when it was at like about $14. And I've been in and out of the trade for it. But then lately it's been at $5 and less. I mean, now it's at $4.70. This is the lowest I've ever seen it. So there's a lot of opportunity right now. A lot of opportunity. Um, let's look at gold real quick. I mean, gold's falling. It's not falling significantly, but it is down about $100 um, in the past. What you call it? Let me see what is this layered on. Okay, that's the percentage. So gold is down, but people sell their gold to get liquid. That's what happens in a downturn. People sell gold to get liquid, especially if all of their other assets are just cratering. So as we can see, I mean, this is oh, I got the dark overlaid of it. So as you can see, yeah, I mean, gold's taking a hit. So it's important, like when we're looking at investing, it's important. I mean, look at Nvidia, $94. So it's important when we're investing though is to not just go all in. Like it's important to understand that um, it's important to understand that you want to invest in tranches. So you want to, take a bit of capital. You find a company you want to buy. You buy some of it. Take 1/3 of that money that you set aside to put into that company. Then you say the price falls further. You take another 1/3, put into that company. And keep rinse and repeating that process. You don't want to go all in at once because you could be catching a falling knife, and then you're exposed, right? If the price falls more, you're tripping out, right? And so it's important to understand like averaging in as well. Like me, I like the dollar cost average. So that's something that I like to do. So even in this time of volatility, that's what I'm planning on doing. So I'm going to go ahead and just turn our attention to one last article just to give us some perspective during this time. So expect perspective during this time. This is a article from CNBC, which I don't watch CNBC, but this is one that's actually really helpful, and it's Warren Buffett. Uh, and so Warren Buffett talked about he gave a speech back in 2017 and everything. And those of us that know Warren Buffett knows he's one of the the greatest investors of all time, one of the greatest investors of all time. So this article says stock prices sharply fell on Thursday after President Donald Trump, the day before, announced sweeping tariffs of 10% on all U.S. trading partners and higher levies on countries with which the U.S. has a trade deficit. It talks about the decline. We talked about that. Um, Talks about investors' sentiment. Investors alike fear Trump's tariff policies could ignite a trade war. We talked about that and push inflation higher. We talked about that. Economic slowdown. Talked about that. So let's get to what Warren Buffett has to say. So over the years, Berkshire Hathaway chairman and investing legend Warren Buffett has recommended staying calm in times of volatility. In his 2007 letter to shareholders, Buffett wrote, "There's simply no telling how far stocks can fall in a short period. But should a major decline occur," he continued, "heed these lines from Rudyard Kipling's classic poem, If, which came out in 1895. If you can keep your head when all about you are losing theirs, if you can wait and not be tired by waiting, if you can think and not make thoughts your aim, if you can trust yourself when all men doubt you, yours is the earth and everything in it. So, why keeping your cool pays off? It's worth noting that Buffett was writing about major declines in the stock market in periods like the 2007 to 2009 bear market, during which the S&P 500 lost more than 50% of its value. So, right now we're down 10%. The S&P was down 50% at that point in the 2008 crisis. Those are quite a bit rarer than what's happening now. In fact, corrections in the stock market are pretty standard fare. There have been 21 declines of 10% or more in the S&P 500 since 1980, with an average of intra-year drawdowns of 14%. Of course, investors often don't know if things are going to go from bad to worse until they do. No one can tell you when these things will happen, Buffett wrote in 2017. The light can be the light can at any time go from green to red without pausing at yellow. But whether a decline is modest or short-lived or seemingly long and painful, the message to individual investors is the same. Stick to your long-term plans and continue investing. So for me, it took me a while to learn just to have like a 5-year outlook, at least a 5-year outlook. So that's a philosophy that I've adopted, and that's something that's how I look at things. So when I see opportunities like this, I'm going to continue buying. And it says Buffett writes that he views downturns as extraordinary opportunities. Why? Because historically it's never been all that long before the market resumes its upward trajectory. Since 1928, the average bear market, defined by a decline of 20% or more from recent highs, has lasted less than 10 months. So bear markets have lasted less than 10 months. In the scope of several decades, you will likely plan on investing. That's particularly no time at all. So 10 months isn't much time at all when you have a long-term horizon. Now, it's important to note that the S&P doesn't necessarily include a lot of these cyclical companies like uranium, oil. I mean, they have a little bit of oil, but like uranium, silver, things like that. And so that can be very cyclical. So when we're looking at these upward trajectories, it's important that we know that when we're investing in cyclical commodities, based off a commodities bull run, it's important to take your profits, right? This isn't saying like, hey, stay invested in uranium for 20 years and it's always going to go up. That's not the case. There's going to be a time where uranium is going to sell off significantly. I mean, it's already selling off right now. Um, but I don't think we've really reached that demand supply gap like how we really how it's projected in the next 5 years. That's supposed to be massive. So I think that the prices are going to go crazy during that time. So I'm buying now while they're depressed because I think that in the future, based off supply and demand projections from Sput, from Yellow Cake, from many others, I think that this is going to be a massive opportunity. So now, with that said, that's been said for multiple years, and that's why it's important to have a long-term outlook. But so with cyclicals, this advice I look at differently. But with the high quality names now that are sold off, like the S&P 500, whether you get into the SPY, we just looked at Nvidia, we looked at Apple, things of that nature. So if you're into those types of companies, those blue chip stocks and such, then this is something that is very applicable. I mean, some aspects are applicable to the cyclical stocks, but not all. Like as far as the where it talks about how the market has always recovered. And it's like, yeah, I'm not holding uranium through when uranium spikes up super high. I'm not holding that long term. I'm taking those profits and I'm moving on. Okay. So just to get back to the article, and even if living through it can be scary, keep your eyes on the prize, your long term goals by continuing to consistently invest as the market declines. You effectively buy stocks when they're selling at a discount. As long as you take a well diversified approach to investing, you'll get a better and better deal the further the stock prices fall. So, having a well diversified approach and then also not throwing in all your capital at one time. As Kipling says, keep your head, ignore the breathless headlines, and keep doing your thing. Will the earth and everything in it be yours? Maybe not, but you will likely do a good job of boosting your long term wealth. The whole attitude recalls another quote of Buffett's about taking advantage of bargain priced investments, this time from his 2009 shareholder letter. Big opportunities come infrequently. So, this is during the great financial crisis. He says, big opportunities come infrequently. When it's raining gold, reach for a bucket, not a thimble. So, just giving some wisdom here from one of the greatest investors of all time, and I hope that you all are weathering the storm well. If you see some opportunities, I wouldn't be hesitant to take advantage of those. I would just be wise in how much capital I'm throwing there, just um, so that I'm not putting all my money in at once. So this is just some tips that you can take with you. This is how I'm processing everything that I'm seeing today, and just wanted to give you all some tips. So I hope that you all have a blessed day and everything. I will be back live again soon and everything. So